so I do think that we're likely in a multi-year, ups and downs, but a longer term commodity bull market until the prices go up enough that enough new capex comes online and starts the next cycle. So yes, I'm broadly bullish on commodities with different time frames, generally long term, especially centered around energy. Coincident with that would be gold revaluation, basically central banks turning back more towards gold. And then also technology now allows money to pierce borders more easily with things like Bitcoin, stable coins. So I think in many cases, countries are going to have a harder time imposing their own little currency bubble. We're kind of watching the Game of Thrones of money right now, which is a couple leading network effects kind of coming to a head in the years and decades ahead.
In today's episode, Lyn Alden uncovers the forces shaping the future of global finance. She highlights the unfolding multi-year commodity bull market, driven by energy and precious metals like silver and gold, and warns that central banks might soon initiate a significant gold revaluation. But that's just the beginning. Alden also reveals how digital assets like Bitcoin are breaking down borders and challenging the dollar's long-standing dominance. Are we on the brink of a financial revolution? Stay tuned as we dive deep into these crucial shifts and explore what they could mean for the global economy and your financial future.
So I generally don't like the word super cycle, but I do think we're in a commodity bull market. I don't really know how to define a bull market versus super cycle, so I just call them bull markets. But it's basically tied to the capex cycle. You have a period of rapid capital expenditure, new sources of energy, new deposits all coming online, and eventually you flood the market with too much. You have some sort of economic slowdown, which hurts demand. Then you kind of enter this long period of oversupply, cheap prices, lack of capex. And going forward, I think that's turning, and it's really been turning since kind of the pandemic bottoms. And so I do think that we're likely in a multi-year, ups and downs, but a longer term commodity bull market until the prices go up enough that enough new capex comes online and starts the next cycle. So yes, I'm broadly bullish on commodities with different time frames, generally long term, especially centered around energy. In general, when you have a structural, commodity bull market, it's usually because the dollar's weakening, and it's because the commodities are going up in value. So a lot of these things tend to move together. So I just kind of by extension, I'm bullish on silver. It has a number of industrial applications. It still has some degree of monetary premium. Ever since the dawn of the telegraph, the silver has lost a big chunk of its monetary premium, and what I mean by that is the gold to silver range of trading was pretty much between 10 and 20 for like thousands of years. And ever since the dawn of the telegraph, where we've relied less on silver's divisibility for money. So basically for eons, gold was like the money for merchants and monarchs, and silver was money for the people. But when we start using banknotes and bank accounts and things like that, and we started abstracting gold, people kind of dropped silver, and so silver got left behind. And in its current environment, we see central banks are stacking gold, not silver. That's where big pools of capital go, because you get a lot more value dense, for what you're doing. And so I think that silver is likely to come along for the ride, and it has its own supply demand characteristics. But I'm broadly bullish on most large commodities. So a lot of it comes down to what the world is using as their settlement asset, their reserve asset, basically the world's money.
Lyn Alden states that in the older era, gold was the foundation of the financial system. Over time, this shifted to a gold-backed dollar, and in the modern era, the dollar itself became the foundation, partly linked to oil, but primarily due to its strong network effect. While states can impose their currencies on their own populations to some extent on an international level, currencies must compete for network effects, liquidity, and capital markets. The strength of the dollar lies in its established network effect, but Alden warns that this system is becoming increasingly stretched. She suggests that the future direction of the global financial system will hinge on a few key factors. One possibility is the emergence of a more multipolar world, where the dollar competes with other currencies. This would challenge the dollar's dominance due to the complex network effects involved. Another factor is the rise of digital assets, particularly neutral, open-source ones, which pose yet another challenge to traditional currencies. As digital assets gain traction, they could disrupt the established financial order, which still heavily relies on more traditional, analog systems favored by existing powers.
That's a good way to describe it. That within the context of an overall portfolio, it's a defensive action, even though as its own slice, it can be quite volatile. You have geopolitical risk can happen in the sense that countries, they can do windfall tax profits like on it. There's all sorts of things you have to pay attention to supply demand characteristics of the industry. The bullish thesis could be wrong about the supply side, the demand side. There's a number of risk factors that can threaten the bull market, but I would say the combination of producers have pretty low valuations. A lot of them have decent balance sheets now. They're not reinvesting a lot heavily into capex. They're just kind of returning value to shareholders and maintaining their capex. Obviously, some are growing, some are not. But as an industry, it's not super aggressive. And also, the commodities themselves offer, I think, some good long-term holding periods. And the way to think about it is that the past 30, 40 years of disinflation, stocks and bonds were the big inverse correlation trade. But in more inflationary environments, they tend to have more positive correlation.
Lyn Alden explains that higher bond yields can put significant valuation pressure on equities. For instance, if you can secure a 6% return on a 10-year bond, you might hesitate to invest in a medium growth equity with a price-to-earnings P ratio of 30. You may choose to wait until the P ratio drops to 20, offering a 5% earnings yield instead. In such an environment, bonds, particularly long-duration ones, become less effective as a hedge. Alden believes that energy and commodities serve as a better hedge in this scenario. When considering potential disruptions to an equity portfolio, such as inflation spikes or material shortages, owning energy and commodities can offset the impact on assets that typically thrive in a disinflationary environment. While equities tend to favor stability and disinflation, commodities, along with a few other industries, are more suited to periods of inflation and economic turbulence. By holding a mix of both in your portfolio, these assets can complement each other, balancing risks and returns across different economic conditions.